Good morning, everyone. This is Tara Sewell, internal wholesaler with Financial Markets. Thank you for joining us today. Your lines are muted. If you have questions, please reach out to your internal wholesaler after the call. Our winner today will have a choice of a locking gun safe or a Pit Boss smoker. And today, Neil Sperling, Vice President of Financial Markets, will show us 3 easy and legal tax avoidance arrangements. All of you play a critical role in ensuring that clients continue to have access to the protection and the opportunity that life insurance and annuities provide. Thank you to all the producers on the call. Together, we protect families and their financial futures. Congratulations to Roy. He was our winner of the summer giveaway. And congratulations to our runners-up. Now let's dive into the details for our fall giveaway. For every application submitted from July 14th through September 29th, you earned 1 ticket. You also earned 1 ticket for every $10,000 in anticipated annuity premium and 1 ticket for every $1,000 anticipated life, Medicare supplement, disability income, or long-term care premium. Your tickets were doubled for applications with our premier carriers, and you received triple tickets if the case was place paid by September 29th. Today, the odds are in your favor. We have a total of 4,118 tickets in our hat. Your name can only be drawn once. You must be pre-registered with your full name and be present for the duration of the webinar to be eligible to win. There are many great tools and resources available to you on our website, fmiAgent.com. Our latest is FMI Vive. This is an amazingly fast and easy way to quote and submit applications for simple term life insurance cases. Take the work out of your routine term sales with FMI Vive. After simple common inputs, you can quote multiple face amounts and multiple term durations in just minutes. The FMI Vive score suggests carriers not just by price, but by the quality of product, the quality of conversion options, and the ease of current underwriting and process times. From here, you can drill down and compare multiple product details. Once you select the product to apply for, you are presented with a common set of questions to a drop ticket. The ticket is then fed directly into the carrier workflow for their respective drop ticket process. Check out FMI Vive with your next term case at fmiAgent.com. And now, we are excited to share with you 3 easy and legal tax avoidance arrangements with Financial Markets Vice President Neil Sperling. Neil?
Good morning, everyone. Thank you, Tara, for starting us off here today. Today, we're not going to look at products as much as some concepts you can deliver to your clients to assist in tax management. While we do have some CPA advisors here on the call today, please know this session should not be considered authoritative tax advice. I and Financial Markets encourage you and your clients to seek appropriately educated and licensed advisors for any tax-related matters. The content today is based on our best understanding of the tax code from a layperson perspective. Okay, now we got that legal disclaimer out of the way. Let's look at 3 easy but legal tax avoidance arrangements. But first, how about a quote from old Ben? Back in 1789, Benjamin Franklin wrote a letter to then physicist and publicist Jean Baptiste Leroy and said, "In this world, nothing can be said to be certain except death and taxes." So far, his statement rings quite true still today. One of these perils we can at least manage and avoid through proper planning. I'll let you professionals decide which one that applies to. The most successful and vibrant country the earth has ever known has a completely voluntary tax system. The U.S. system of federal taxation is voluntary, meaning taxpayers determine their own taxes by their own calculation. While technically the U.S. tax system is voluntary, payment of taxes is, unfortunately, not the voluntary part. Payment of federal income tax is mandatory. The framework in which taxpayers use to determine the amount of tax they owe is the law of the land. And as we well know, if us taxpayers voluntarily choose not to comply, stiff monetary penalties may apply. And in the instance of fraud, of course, potential criminal penalties may apply. So as the title implied, today we will look at 3 relatively easy ways to avoid tax, the legal way. While there are opportunities for commissionable sale transactions with these methods, these topics will mainly make you look like a hero to your clients where appropriate. First, we will look at a way to kick the can down the road and defer taxation. Then we'll look at a redirection of taxable income to completely avoid all taxation on those distributions. And last, we will look at prepaying taxes, somewhat like paying tax on the seed rather than the harvest. Okay, so let's dive in. The first tax avoidance arrangement we will discuss is the QLAC. The QLAC has become a very popular discussion item for many retirees as it relates to required minimum distributions. So what is a QLAC? QLAC stands for Qualified Longevity Annuity Contract. A QLAC is solely intended for qualified funds such as IRAs, and those qualified funds allocated to a QLAC have no required minimum distribution requirements. We'll look at that in detail, but a couple of benefits as a result of a QLAC arrangement could include avoiding entering a higher income tax bracket, avoiding Medicare excess income penalties, and even helping tackle the monetary risk of living too long. A qualified longevity annuity contract is a relatively new type of deferred income annuity that was created as a result of a July 2014 U.S. Treasury Department ruling. The ruling addressed and solved a problem for many qualified account holders and made the purchase of a deferred income annuity with tax qualified funds from an IRA or 401k account much more attractive option. While allowing up to $125,000 to be allocated to this arrangement, which was limited to a maximum of 25% of the taxpayer's total qualified account holdings. Prior to the ruling, if you wanted to purchase a deferred income annuity with tax qualified funds, you were required to start your guaranteed income payments no later than age 73 in order to satisfy IRS mandated required minimum distribution rules. But now, if your deferred income annuity meets certain requirements, it is considered a qualified longevity annuity contract, allowing a taxpayer to defer the start of your income payments to as late as age 85, while at the same time bypassing the normal required minimum distribution rules on the funds allocated to the QLAC. Then with the Secure Act 2.0, spelled out in its section 202, it removed the 25% restriction and raised the maximum contribution limit, making QLACs a much more attractive strategy than before. It also facilitates the sale of QLACs with spousal survival rights. The provisions of the Secure Act 2.0 are effective for contracts purchased on the Act's enactment date of January 1st, 2023. So what is a QLAC exactly? It's available to taxpayers to purchase with qualified funds through their age 83 with as much as $200,000 of their qualified account holdings. Income payments, while taxable, can be deferred all the way to the taxpayer's 85th birthday. Basically, this is an immediate annuity with an income payment start date no earlier than 13 months after its purchase date. Payment options include the typical payment options found in a traditional immediate annuity, including life only, certain only, joint and survivor, along with period certain, installment refund, and lump sum upon death options. I won't go into all of the income option details, but if you'd like to discuss these, please reach out to your internal wholesaler here at Financial Markets for more details. So here's an example of a QLAC. Here's a potential client, age 70, placing $200,000 of qualified funds into a deferred income annuity classified as a QLAC. Here we show deferring the income start date to the client's 85th birthday. While the start date can be earlier than age 85, it can be no later than the taxpayer's 85th birthday. Most carriers allow flexibility in the start date of up to 5 years earlier than the originally selected date. So in this example, the taxpayer could elect to begin income as early as age 80. Keep in mind the income payments will be lesser if exercised earlier than anticipated. Okay, so the 70-year-old male client places $200,000 into a QLAC and does not have to do required minimum distributions on these funds ever. Once the client turns age 85, the insurance company begins income payments, which are fully taxable as ordinary income to the taxpayer. Earlier, I mentioned this can help tackle the risk of living too long. This is a really great tool, not just for deferred taxable income, but to provide income in the later years when other retirement assets may have already been depleted. Now, the guaranteed income from this example is $5,180 per month, and with the options selected, these income payments will continue as long as the client shall live. When the person dies, if the cumulative payments received do not exceed the original purchase amount, which is $200,000 in this case, the difference will be paid to the named beneficiary in a lump sum. Keep in mind, this is just one of the payout options, but you can see how this could play an important role in the longevity risk while avoiding the necessity of required minimum distributions on the amounts allocated to this arrangement. You can run QLAC quotes at fmiAgent.com for your prospects. The carriers we currently offer include American General, Forethought, Lincoln, and United of Omaha. Also, while today we discuss this type of annuity for use with qualified funds, deferred income immediate annuities can also be purchased with non-qualified funds for other planning needs outside of the QLAC type of arrangement. Okay, now let's look at a second easy way to avoid taxation. The QCD. A QCD is a qualified charitable distribution. We'll go into detail, but in short, there is no reportable taxable income with this arrangement, resulting in what? Zero taxation. A qualified charitable distribution is allowed for persons age 70 and a half and older and can be used for up to $100,000 per tax year. With this arrangement, for a person with fully taxable qualified funds, they can request their financial institution to send a distribution directly from that institution to a charity. The appeal here is that there is no reportable income to the account owner for this distribution. So let's take a look at how this works. So with a traditional qualified account distribution, with the ultimate goal of giving it to a charity, the taxpayer will request a distribution from their institution. Once received, they turn around and write a check to the charity. At the end of the tax year, they receive a 1099-R representing the distribution amount. They include this amount in their gross income calculations. Then, if they are able to itemize their deductible expenses, they line item deduct the charitable gift. This results in no taxation for the amount given to the said charity. However, it may be indirectly taxed through state income tax, Medicare, and other surtaxes unintentionally. This is where the beauty of the QCD, the qualified charitable distribution, comes into play. Basically, the QCD skips the middleman in this case being the taxpayer. So with a QCD, the taxpayer requests their financial institution to distribute the qualified funds directly to the nonprofit charity. The funds are never received by the taxpayer. Rather, the charity receives them directly from the institution. This results in zero reportable income to the taxpayer, and thus requires no itemized deduction reporting and no unintentional fringe taxes. It's a really, really great tool for charitable persons. Okay, so let's switch gears back to RMDs. Most of you are familiar, but we'll just do a quick refresher. Required minimum distributions came about as a result of the huge Tax Reform Act of 1986, and it has since been the law of the land. RMDs are a dictate of tax code where pre-tax funds that have accumulated over time are required to be distributed to the taxpayer in increments annually beginning at a certain age. Recent tax changes have extended the start age of these distributions, as you can see in the chart here. This shows when these RMDs must begin. Historically, not taking these distributions could result in as high as a 50% tax penalty for the funds not properly distributed. Under current tax law, the penalties are from 10 to 20% depending on certain factors. But all in all, the taxpayer was allowed to invest pre-tax funds and allow those funds to be tax deferred for the majority of their life. Now, in the retirement phase, the IRS wants its taxes and requires these distributions as a result. RMDs are such a great conversation starter. Oh, and by the way, it's October. December is just around the corner. Please, please encourage your clients to get their RMD requests in soon. Once December rolls around, it becomes difficult to get RMDs processed by year's end. So get those RMD forms in as soon as you can. Okay, so back on the topic. I think we can categorize persons in 4 camps as it relates to RMDs. First, the persons who need more retirement income, or perhaps they're not even able to be retired yet. These persons need their RMDs if they even have any qualified accounts left. Others may be doing well, but there's no excess funds in the budget. Those persons may need to use those qualified accounts through RMDs or otherwise for emergencies, regular living expenses, or some simple pleasures. Then there's old Ebenezer Scrooge. They have plenty of money, plenty of income for a comfortable or even lavish retirement lifestyle, but they are not inclined to just give away those hard-earned assets. Those folks will just take their RMDs as required and enjoy the spoils personally. The last one, and I like to think that this is most persons with sufficient retirement assets, they'll consider giving to charity. And they may do just that with, in fact, their RMDs. So this next concept is intended for the charitable type of person with sufficient retirement income or assets. They're inclined to give. The question is, are they giving in the most efficient way? Your mind may be moving ahead of me by now, but let's ask a question. Just a moment ago, we looked at the qualified charitable distribution. Could we combine that with the required minimum distribution rule? The answer comes from a friend I know in North Dakota that lives right near the Minnesota border. The answer is, you betcha. Let's take a look. Now, this is a bit of a busy slide, but let's compare the old way and the new way of using RMDs for charity. This example is for a 75-year-old filing as a single or married filing separately. This person has $100,000 in taxable income and holds $250,000 in qualified retirement accounts and needs to take his RMD this year. This first example is for this transaction as if it occurred in 2017 prior to some recent tax law changes. So his RMD is a little over $10,000. This brings his end of year taxable income to a little over $110,000 before deductions. The standard deduction for a single person in 2017 was just $6,350. Once he received the RMD, he turned around and gave that same amount to charity. Since the standard deduction is less than the amount he gave to charity, he itemized the deduction of $10,163. This ultimately ended in $100,000 of taxable income. At a 20% rate, pretty simple, the tax due for the year was $20,000. Moving to the same scenario in 2023, let's see how things have changed. While given the same age of 75, the RMD amount is the same, the income is the same, but the itemized deduction changed, or the standard deduction changed. Now the standard deduction is all the way up to $13,850. Since the standard deduction exceeded the amount he gave to charity, there's no point in itemizing his charitable donation, and he elects to just take the standard deduction. Now the good thing is, given the same 20% tax rate, with now just $96,300 and change taxable income after the standard deduction, he only owes a little over $19,000 in tax. Worked out pretty good for him in this case, but could it be better? And the answer is yes, by using the QCD. The qualified charitable distribution method, he's going to save over 10% in taxes. So again, the same income, the same RMD, but he has the financial institution send the RMD directly to his charity, thus avoiding taxable income reporting. Now, in this case, we're only showing doing the QCD for the amount of the RMD, but keep in mind, the QCD can be done for amounts as high as $100,000 per tax year. But anyways, by using the QCD, the gross reportable income remains at $100,000 instead of that $100,000 plus the RMD. He still gets the $13,850 standard deduction, leaving just $86,000 taxable income. The result is paying over $2,000 less in tax, which represents 10.5% less being paid in taxes as compared to the situation not using the QCD. This is something your clients would love to know about. And doing a QCD is really easy. The institution likely has a form where the account owner simply requests a withdrawal to be processed and sent directly to their charity. This is an example of a QCD request form. As you can see, the account owner just lists the charity information, and the check is sent directly to the charity or the account owner, but made payable to the charity. Pretty simple. So tell your clients about the QCD. They'll be glad you did. And you will look like a hero that we all know already that you are. All right, moving on to the next topic, the US debt. The US debt, it's staggering. This screenshot from usdebtclock.org was taken yesterday. It shows the US has $33.4 trillion in national debt, with over $700 billion in annual interest on the debt. It also shows a whopping $194 trillion in total US unfunded liabilities. Also, according to the Global M1 Supply Report, the total value of all money in all currencies worldwide was $48.9 trillion as of November of 22. So the US currently has debt nearing the value of all the money in the world. While this information is shocking, what do you think this means for US taxpayers? Here's a chart from taxpolicycenter.org on the marginal income tax rate history. The graph shows we're in pretty good shape right now. Looking within the numbers, the average tax rate since 1913 is 49.77%. The average over the past 100 years is almost 50%. Maybe prepaying retirement tax is something consumers should consider in retirement planning. After all, we do not know what the future tax rates will be. We don't even know what the tax rates are going to be in 2024, which is only a few months away. Where do you think federal income tax rates are headed? Where do your clients think federal income tax rates are headed? My conclusion from this chart is that taxes are on sale. Do you want to buy high or buy low? Well, if you must pay taxes, why not buy low? Let's head back to the US debt clock. As mentioned before, it shows the US has 33.4 trillion in national debt. But what does that mean to you and I? Each citizen is on the hook for over 99,000 in debt currently. But notice the corresponding population, the taxpayer. The debt per taxpayer is nearly 260,000. At some point, taxes will go up, and taxes directly affect the so-called taxpayer population. In which population do you and your clients want to be in retirement? I personally would prefer to just be a citizen rather than be in the taxpayer group shown here. After considering the current and potentially higher future tax rates, everyone that owns an IRA or similar tax status account has a close partner in retirement, good old Uncle Sam. In 2023, the federal tax rate is anywhere from 10% to 37%, depending on the amount of taxable income and their filing status as a taxpayer. While over the years, these people enjoy deducting their contributions, now at harvest time, paying taxes on the fruit of their investing doesn't feel that great. More recently, since 1997, there was a start of the popular Roth IRA. While no deduction on the front end for the contributions, the distributions are generally income tax free, as you know. I would contend that tax planning is the single most important component to retirement planning today. This is the third tax avoidance strategy to mention today. 2023 may be the year for Roth conversions. Now I get it, your clients don't want to pay taxes on their distributions. Further, the thought of paying a large sum in taxes to convert a tax-deferred qualified money to a Roth is probably not a fun topic, but the fact is, historically, income tax rates are probably the lowest today that we may see in decades. What if a person converts a huge IRA and pays the 37% top tax rate today? While there'll be many opinions to whether that's a good idea, the fact is that if you do convert all deferred qualified funds in a client's portfolio to a Roth, you have eliminated the risk in retirement on those funds, as the tax code is currently written, to have Uncle Sam as the partner. If you'd like to discuss Roth conversions, give your internal wholesaler here at Financial Markets a call. We have several options, and we even have some carriers that allow systematic Roth conversion plans where you can convert a portion of the funds each year, which will spread the taxable income to multiple tax years. Roth conversions are an excellent topic to discuss in an overall planning strategy. Hopefully you thought of some clients or prospects you can help with the information we presented here today. There are two things certain in life, and one of them can be managed. One thing that's certain today is that we'll have 5 winners in the drawing, and one of those 5 will be getting a Pit Boss smoker or a locking gun safe. Thank you for your business, and with that, I will turn it back to Tara Sewell.
Thank you, Neil. Now, as you think of clients who may be interested in avoiding taxes through the qualified longevity annuity contract, a qualified charitable distribution, or a Roth IRA conversion, don't forget to reach out to us here at Financial Markets to your internal wholesaler. We look forward to helping you with your next case. Now, let's get started for our first and second producer draw in our drawing today. Pull up our hat. Again, we have 4,118 tickets in the hat. We're going to drop these in and draw our first finalist. Wayne Martin with 202 tickets in the hat. Is Wayne on the call today, Neil?
And Mr. Wayne Martin is on the call.
Congratulations, Wayne. You are our first finalist. Now let's draw our second finalist. Paul Funkhauser with 23 tickets in the hat. Is Paul on today's call?
Paul is not on the call.
All right, folks, you do have to be on the call and present. When I draw your name, let's draw for our second finalist. Rich Elliston with 424 tickets. Is Rich on the call today?
Wow, we had 424 tickets. That's great. And Rich is on the call.
Congratulations, Rich. You are our second finalist. Now, you can subscribe to the Financial Markets YouTube channel at youtube.com/fmiAgent. You will find webinar replays, sales concepts, case studies, consumer videos, and Dow's Weekly Digest by our very own Ed Bartling. Now you can also catch the season's brighter summer days. Let's draw our third and fourth finalists. Let's pull our hat up here again. Dave Okeson with 47 tickets. Is Dave on the call today?
And Dave is not on the line.
Okay, so far we have Wayne Martin and Rich Elliston. We are looking for our third finalist. And we have drawn Wayne Martin again. He can only be drawn once, so we're still looking for our third producer. Jeffrey David with 39 tickets. Is he on the call today?
He is not on the call.
Okay. Well, we are still looking for our third finalist.
Oh, Wait a second.
Oh,
I knew there was the gentleman goes by Andrew, and he is
oh,
on the call.
yes, he does
And
go by Andrew.
so we do have a third finalist there.
Okay. So to recap, we have 3 finalists so far: Wayne Martin, Rich Elliston, and Andrew David. We're looking for our fourth producer. Vera Banks with 47 tickets. Is Vera on today's call?
And Tara Vera is not with us here today.
Okay. And we will draw again. Helen Dale with 28 tickets. Is Helen on the call?
Helen is not on the call.
Okay. We will draw our next producer, Kurt Sinclair with 41 tickets.
And Curtis is on the call.
All right, congratulations, Kurt. You are our 4th finalist. So our finalists are Wayne Martin, Rich Elliston, Andrew David, and Kurt Sinclair. Another amazing resource at fmiAgent.com is the Virtual Sales Assistant. This tool includes hundreds of planning concepts, tax guides, specimen documents, and more. Let's take a look at an example under concept pages. The documents are listed by topic. Let's go to buy-sell planning. Under business planning, in this example, I will click a buy-sell concept. Here you will see a client-friendly diagram with an explanation on how the process works. There are no carrier logos or branding, which allows you to use these resources in a variety of situations. You can access the Virtual Sales Assistant on our website by clicking Agent Tools, Advanced Marketing Resources. And now we will draw our last finalist. Brian Waits with 39 tickets. Is Brian on today's call?
Brian is on the call.
Congratulations, Brian. So our finalists today are Wayne Martin, Rich Elliston, Andrew David, Kurt Sinclair, and Brian Waits. And I'm going to switch this over to you, Neil, while I put together our tickets.
Fantastic. Well, congratulations to those in the finalists of the drawing here. Folks, it's simple. It's easy to get on our 2023 FMI Agent Point Awards trip. We're floating on a cruise ship all the way to Bermuda. Should be a great time. Just $30,000 a life premium or $1 million of annuity premium or any combination thereof on this cruise to Bermuda on Royal Caribbean. It's going to be a great time. The sail date is May 4th of 2024. Qualification period ends January 15th of 2024. So get those apps in, get those apps placed, and get your points in the point awards to go on the cruise with us. We look forward to hosting you for another unforgettable trip.
It's going to be a great trip indeed. All right, I have our new hat shuffling here. Let me just pull this over. So we will be drawing for a Pit Boss pellet smoker or a locking gun safe. And I've got these shuffled up here. Drop them in the hat. And here we go. Wayne Martin, congratulations on you. You are our finalist, and you will be contacted today for your choice of a Pit Boss smoker or a locking gun safe. And congratulations to our 4 runners-up on winning the custom-made, made in the USA cutting boards. And as we come into the 4th quarter, that means our Christmas giveaway is coming. This promotion starts tomorrow. So watch your inbox for details. Thank you for your time today, and thank you for your partnership and your loyalty. Have a beautiful day.